Back with us here on Chartbusters. Now, Protean eGov is looking to bid for the IT department's project for the development and maintenance of PAN 2.0. Now, CNBC TV 18's Yash Jain caught up with the management to get a fix on the company's prospects and began by asking him about the new business verticals that the company could scale up in. Listen into a slice of that conversation.
Our large assets, which are today mature businesses in a manner of speaking, are in the space of taxation, in the space of pension, and very clearly in the space of provisioning digital identity. So as you said, we are meeting customers, or we have, fintechs around us. Today as an organization, on purely the provisioning of digital identity, we power the entire BFSI sector, right? So that is a very clear, big line of business for us, because we are one of the companies which is uniquely positioned. All four facets of digital identity are provided by us, which no other company in the country does, because we provide services as a service agency to UIDAI, which is on the back of Aadhaar, whether it's eSign, eKYC, or e-authentication. And by virtue of the fact that we issue the PAN card on behalf of the IT department, we also hold the PAN database. So online PAN validation is another service we offer. So when you're completing any digital onboarding journey, you're completing any identity authentication journey, capital markets transaction, transaction in the property space, you're somewhere or the other touching a Protean, asset behind it. So directionally, we are also seeing that while we continue to go strong in contributing to the digital public infrastructure, as you know, we've moved beyond tax, pension, and ID and gone into digital commerce with ONDC. We are looking at education and skilling, health, agriculture. We also want to play as a vertical, integration, and now contribute at the app level. So the app layer. And that is where we are looking at contributing in the buyer-seller space with ONDC. We built a complete open commerce stack over there. We are looking at, again, doing a lot of stuff on the data stack, where we use our account aggregator license also. And we are looking at credit scoring, and similarly areas like providing digital onboarding and lending journeys completely as an end-to-end application.
A lot has happened. A lot of investments have been made in terms of the infrastructure that you wanted to build. Traditional businesses are firing well, and now you're looking to add new businesses, which I am assuming will give you a better margin profile. Keeping all of that in mind, and then looking at FY25, what kind of revenue growth should one expect in terms of all these three things coming together? And margin profile, as I said, new businesses also getting added. The blended margins, could they go back to those 15-16% levels? Could we get to see that?
So let me break it up on two aspects. See, largely our investment has been in people and tech. We continue to remain an asset-light company. Especially what we are doing in the new age DPIs is largely done on open source technology. So consequently, as a result, there is no heavy infrastructure capex expenditure coming in. So you're right, the existing businesses continue to be strong. They have headroom, but they are a source of stable growth.
Correct.
As we look at new businesses, since we are in a way doing a vertical integration, we do see that there's a better margin profile in these businesses because of the value-added services you are giving, which is not at the foundational layer, but at the app layer. And that is where we see the margin profile to be better out of them. But since these are new businesses, I will break it into two parts. We feel that largely our investments in people and in tech have been done. The new products are there, they are out in the market. But to see the monetization coming through, we definitely see it a journey which will take, in the next couple of years to really start showing impact into the margin profile of the company.
Okay. Still waiting for those two numbers from you. For FY25, the revenue growth could be around what levels, if you could guide the street on that?
I can't make a forward-looking statement, as you're aware.
But could it be in the range of about 20 to 25% going forward? Because FY24 was a strong year over a strong base. Could it be similar to those levels, and could margin profile improve from where you were at FY24?
So as I'm saying, we will definitely see new businesses firing. We've launched quite a large number of new products this year. You would have seen us talking about We've launched a full stack of API marketplace on Protean Rise.
Correct.
We've done CKYC, which is again a great need of the fintech sector, the BFSI sector, rather the bank's compliance and putting up the KYC data. eSign Pro is something we've launched, a complete documentation suite. So all these are basically our interventions which are coming on top of the infra layer. These products will definitely kick in because most of the launches have been done in the last quarter. So we still have 2 quarters to start seeing returns on these. So definitely we see there'll be improvement in margins with these contributing in. And as I said, on the bottom line in terms of the investments, the people and the tech is there. The new products coming in will definitely improve the profile.
Okay, interesting chat there Yash had with the management of Protean. But for the time being, we slip into a short break that promised chat with the management of Laxmi Organics on the other side. Don't go anywhere.